Good morning, welcome back to the Daily Play presented by Marketplace.com. We're going to start today's episode off with a pop quiz. You ever seen a stock do this? Well, if you're a Lyft shareholder, that was your reality earlier this week. But what causes a stock to rocket up more than 60% and then immediately crash 20%, all in under an hour? Well, let's look at it. Lyft reported their Q4 2023 earnings after market close on Tuesday, and it was a really solid call. While Lyft still isn't profitable, they only lost $26.3 million in Q4 and only $340.2 million in all of 2023. And while these numbers sound like a lot, and that's really because they are, that's really not much in Wall Street terms, especially when you compare the fact that Lyft lost more than $500 million in Q4 2022 only a year ago. That stat alone shows massive improvement for Lyft and really shows the company is well on its way to profitability. Along with some other metrics announced like more customers, more rides booked, and a favorable outlook for 2024 that beat analysts' expectations, Lyft was looking good. But this was all overshadowed by one typo. In their earnings report, Lyft mistakenly announced that their profit margins would grow by 500 basis points or 5% in 2024. And for a company nearing profitability, 5% is huge. Let's not forget that improved profit margins is a lot of what caused Meta to do this only a couple weeks ago, so we already know that Wall Street values profit margins extremely highly. On this news alone, Lyft's stock jumped more than 60% in aftermarket trading. But the fun was short-lived. On their actual earnings call, Lyft's CFO came on the call announcing the typo, stating that the 500 basis points was actually meant to be 50 basis points or a 0.5% increase in profit margin. And while that's still pretty good, it is more in line with what analysts expected for Lyft. And that immediately triggered a 20% sell-off for the stock from its previous high moments ago. Don't let that typo overshadow this amazing earnings call by Lyft though. This is still a solid earnings report and shows that the company is closing in on Uber, who became profitable about a year ago. And the stock is still up 30% from its opening price on Tuesday on the actual earnings call, no typos needed results alone. But what do you think though? Does this make Lyft a buy? Have you been buying Lyft for years? Or are you staying away from gig economy stocks? Come let us know and join the conversation. Marketplace.com, link in our bio to sign up.